Greetings from MWN.com. Subject videos for B.Com, B.B.A, M.Com, and M.B.A are available in YouTube channel MWN.com. Students and teachers can utilize it for easy learning of all tough subjects without any strain. Please subscribe MWN.com. Dr. M. Wilson is happy to welcome to this session of Accounting for Decision Making. Fundamental Principles of Accounting Introduction. The history of accounting is traced back to the period of the introduction of money. There are evidences that accounting was applied 23 centuries ago, from the books entitled Arthasastra, written by Kautilya, a minister of King Chandragupta. In ancient days, accounting was in a premature state. The number of transactions during these periods were very few. Hence, it could be operated and checked by the proprietor himself. The accounting based on double entry system was first introduced by Luca Pacioli of Italy in 1494 through a book entitled Principles of Double Entry System. The use of accounting has become most common due to the growth of industries after the Industrial Revolution. Definitions of accounting. The American Accounting Association defines accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decision by the users of the information. The American Institute of Certified Public Accountants defined accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are, in part at least, of a financial character and interpreting the results thereof. According to the definitions, the functions of accounting is stated as follows. 1. Recording of transactions. The basic function of accounting is recording of transactions associated with money. Journal is the primary book to record the transactions. The transactions are written from journal to the secondary book called ledger. 2. Classification of transactions. The transactions are classified according to different common accounts and posted to respective accounts. All the classification is done in a ledger. The transactions recorded in the journal won't give a clear idea about the total transactions in a year. but it can be easily identified from the ledger. 3. Summarizing of transactions. In a ledger, classified accounts are summarized and balance of each account is calculated. All the balances are transferred to an account called trial balance. Final accounts, i.e., profit and loss account and balance sheet, are prepared on the basis of the trial balance. 4. Interpretation. On the basis of trial balance, trading and profit and loss account and balance sheet are prepared. These statements give a clear picture about the profit of the company and the strength or state of affairs of the company. This information is used for future planning and decision making. Definition of bookkeeping. Bookkeeping is defined as the art of recording the business transactions in a systematic manner in the books of account. A bookkeeper is responsible for keeping all the financial records. Hence, the work of the bookkeeper is clerical in nature. Distinction between bookkeeping and accountancy. 1. Bookkeeping is mere recording of business transactions. Accounting is concerned with the formulation of the system of records, preparation and interpretation of results. 2. A bookkeeper is responsible for keeping all the financial records. But it is not the duty of the accountant for keeping all the financial records. 3. An accountant often reviews and directs the work of the bookkeeper. But the bookkeeper cannot direct the work of accountant. 4. An accountant requires more skill and knowledge than the bookkeeper. Objectives of bookkeeping and accountancy. 1. To find out the profit or loss of the business. 2. To find out the asset and liability position of the business. 3. To provide information to the management for decision making. 4. To know the details about the amount due by the business to various parties and the amount to be received from various parties. 5. To provide information about the business to the proprietors, partners or shareholder. 6. To know about the stock position of raw material, work in progress and finished goods. 7. To know the detailed information about the capital employed and the rate of return on the capital employed. 8. To find out whether errors or fraud are committed by the employees of the concern. 9. To provide information to taxation authorities.